this video, I'll explain how to classify a financial instrument issued by an entity to raise finance when the instrument permits the holder to convert the instrument into a variable number of shares or a fixed number of shares. After conversion of the instrument, the holder of the instrument becomes a shareholder of the entity. But today I'm focusing on the classification of the convertible instrument by the entity issuing the instrument. IAS 32, Financial Instruments Presentation, requires the entity to classify the instrument when it is initially issued. Think of this as the day one classification. In the Statement of Financial Position, IAS 32 says that there are three classifications. Firstly, on the debit side, financial assets. Then over on the credit side of our balance sheet, we've got financial liabilities and equity. And the standard also says that sometimes a financial instrument can contain a bit of both. And this is what the standard calls a compound financial instrument. In this video, I'll explain how to classify an instrument issued by an entity to raise finance either as a financial liability or equity. And I'm focusing on the classification from the issuing entity's viewpoint. Think of this classification as the starting point to the accounting. IAS 32 doesn't cover the detailed accounting requirements. I'm not looking at classification and measurement issues under IFRS 9, as these are discussed later in the CSG and in some other videos. I find I can get confused sometimes with financial instruments, especially when we start talking about instruments that convert. So I'm going to take you through an example to help you understand how the conversion into a variable or a fixed number of shares affects the classification of the financial instrument by the entity that issues that instrument. Let's take a look at an example, and first I'm going to have a look at where an instrument converts to a variable number of the issuing entity's shares. So Growth Time raises some finance by issuing a convertible note valued at $5 million, and they issue this to a company called Investor Limited. Interest is payable annually. The notes can be redeemed for $5 million, that means Investor gets their cash back, or they can be converted into a variable number of ordinary shares in Growth Time. So Investor will become a shareholder of Growth Time. So if they do that, the shares issued will be based on the share price at that time that are equal to the value of $5 million worth of ordinary shares. So for Investor, holding those convertible notes as an asset, as an investment, these are a financial asset under IAS 32. So the classification's pretty easy. We've got a financial asset. But what we need to look at is from Growth Time's perspective, and that's what I'm really looking at in this video. So we know that they're going to be saying debit cash $5 million, but what IAS 32 is asking us to do is to work out the classification. Is this a financial liability? Is it equity, or is it a compound financial instrument? Because that's going to determine where the credit in this journal entry goes. Let's look at what happens over the life of the convertible note. One part of the financial liability definition looks at a contractual obligation to deliver cash or another financial asset to another entity. So let's look at what happens each year. We've got the annual payments for the interest, so we've got outflows happening there. But we've got a financial liability at the end, and that's for the redemption that needs to be made if Investor decides to redeem those convertible notes. So that first part of the paragraph 11 definition is satisfied, so we have a financial liability. But what if these convertible notes are instead converted into a variable number of ordinary shares in Growth Time? And the shares will be issued based on the share price at that time equal to the value of $5 million worth of ordinary shares. So here are two scenarios. So firstly, investor receives 5 million ordinary shares if the share price is $1, and investor will receive 1 million ordinary shares if the share price is $5. So what we see is there's really no risk to the investor. They're getting a variable number of shares so that they still get that fixed value of $5 million. So what we need to look at there is the other part of the definition in paragraph 11 for a financial liability. And it says a financial liability is also a contract that will or may be settled in the entity's own equity instruments and is a non-derivative. So our non-derivative is the convertible note, for which the entity is or may be obliged to deliver a variable number of the entity's own equity instruments. So therefore, this conversion option represents a financial liability. So growth time will classify both the redemption and the conversion elements of these convertible notes as a financial liability. So when the notes convert to a variable number of the issuing entity's shares, they're going to be classified on initial recognition as a financial liability. So now Growth Time knows where to put the credit in its journal entry. It's going to take the credit to a liability account for those convertible notes. Let's move on now to look at what happens when we've got a fixed number of shares being issued. Again, we've got Growth Time issuing a convertible note valued at $5 million, and they're issued to a company called Investor. Interest is payable annually, but now the notes can be redeemed for $5 million or convert to a fixed number of ordinary shares in Growth Time. The shares issued by Growth Time will be based on the share price at that time. So 5 million ordinary shares will be issued to Investor if they choose to convert. Again, Investor says, easy, I've got a financial asset. But what's Growth Time going to do? They've received $5 million in cash. Where are they going to put the credit in their journal entry? It all depends on this classification. So let's start analysing it. Again, we've got the annual payments and we've got this redemption feature. So we can see that there's an obligation there. Again, we look at that paragraph 11 definition and see that we've got a contractual obligation for that redemption. So it's a financial liability. But what happens now with this conversion feature? So here's two scenarios. Firstly, the investor gets 5 million ordinary shares and they're worth $10 million if the share price is $2. But if the share price drops down to 10 cents, the 5 million in fixed number of ordinary shares that they will receive will only be worth 500,000. So the risk is with investor. They're getting a fixed number of shares, but the value of them is variable. If we look back to this other part of the definition of financial liability in paragraph 11, we can see that we don't satisfy the definition of a financial liability. Remember, it said the conversion option needs to be about a variable number of shares. But here, what we're looking at is that we've got a fixed number of shares. So we don't satisfy that other part to the financial liability definition. So here we've got an equity instrument. It's a call option. That is, investor holds the option to buy the shares in Growth Time and they get a fixed number of ordinary shares. So what we find then is the conversion feature in these convertible notes is an equity instrument. So Growth Time needs to separately classify a financial liability in respect of the redemption option and an equity component for the conversion part of those convertible notes. So again, let's go back. What does IAS 32 want us to do? It wants us to classify the instrument when it's first issued. So Growth Time says I've got both a liability and an equity when there's the fixed number of shares. So there's a debit to cash, but the credits will go to a liability account for a certain dollar value and into equity for the remaining amount of dollars. I won't go into those calculations here, but the CSG explains how you do this split accounting for compound financial instruments. So that's how you look at a conversion element into a variable or a fixed number of shares.